So I think we understand that the climate change topic is not one up for debate of whether it's happening. The question is how quickly it's happening and how quickly it's likely to happen in the future. Now, to be very clear, I think the forecasting models are imprecise. And so I do worry, in fact, that some of the models might be too optimistic. When I think about climate change, if we look back over the last 45 years, just to give you a few statistics, the carbon dioxide basically in the atmosphere has gone from 330 parts per million in 1975 to over 410 in the last few years. So a very rapid increase in carbon dioxide accumulation. The natural follow-on from that is greenhouse gases accumulate in the atmosphere as temperatures go up, and we can see globally that temperatures have risen pretty materially. In fact, we've looked back to the 1850s, and there's a very clear long-term progression, with the last 30 years being quite alarming in terms of the acceleration in warming. And if we look at the forecast out to 2050, the scientific forecasts basically say we could see global climate increases or temperature increases of anywhere from 1.5 to 5 degrees centigrade. So when I think about that, okay, that's all interesting, a lot of data there. But where I really worry is the physical effects of this on asset values. And by the way, I tend to focus on physical effects because it's easy for us to get our intellectual arms around. For example, by 2050, if we have a 4 degrees centigrade increase in temperatures, the southernmost 200 kilometers of Florida state in the United States will be underwater. So that's all of Miami, it's South Beach, it's Palm Beach, it's all the fancy cities on the East Coast where people from New York go to retire when they're wealthy. You're talking about $1 trillion plus of residential real estate in those coastal areas alone that could be underwater. Well, that's part one of the discussion, but let's take it another step. It's not like those properties will only go down in value after they're underwater. At some point, if climate change is not addressed successfully, people are going to realize, okay, temperatures are rising, the coastal waters are rising. They're going to say, well, I thought this property would be good for the next 30 or 50 years for my family, but maybe we can only use it for the next 20 years. Well, if that's the case, how much is the property worth? And by the way, properties on South Beach in Miami go for several million US dollars each for a condominium. Do you start to realize the value of your property is actually half of what it was, or 3/4 less than what you thought? And what does that mean then for the mortgage you borrowed, and whether you decide to repay that mortgage, and what does that mean for the mortgage-backed securities that were issued with that loan inside of them? And so there's an entire economic waterfall that comes from climate, not even considering basically the climate refugees you we're likely to see in poorer countries in the world, not considering the health effects of diseases that spread from the tropics. There are so many aspects of this complicated discussion that we should all be thinking about it, and unfortunately I think we've ignored it for quite a long time and are way behind the curve to address it. What we're saying is what matters to us about ESG, the environmental, social, and governance, is how it affects the future profitability of a company. Because we're committing capital for our clients, we have a fiduciary responsibility, and we want to make sure we have a comprehensive assessment of risk and reward. And so our goal right now is to identify in those environmental, social, and governance factors, which ones are actually material to a company's profitability and to their future operations. And let's really focus our research on those material items and then figure out what it means to future earnings and the future valuation of the company. So what we're doing across our global platform is trying to integrate that ESG much more thoroughly and take these things into account when we think about valuation, and then also at the portfolio level, think about where we stand in terms of our overall ESG characteristics. Let's just use, for example, the global beverage space. One of the areas we've done a lot of work on is water consumption. But if you look at what some of the soft drink companies, for every unit of a soft drink they produce, they use 1.6 units of water. That's maybe best in class. There are others who use 4 to 5 units of water. So we've been trying to examine whether it be alcoholic beverages like beer and spirits or versus soft drinks, looking at companies and saying, okay, well, where do you produce globally? Which parts of that supply chain might have water scarcity issues? If you're not efficient with your use of water, are you going to have a viable operation in the long term if you're producing in certain parts of Chile, for example, or other parts of the world where there's a water scarcity issue? And thinking about what the cost of the water will be and what the cost might be of being inefficient, and then building that into financials. And so that's just one example. And by the way, our consumer staples expert could dig into that for about an hour. There's a lot of work you can do around understanding what companies disclose, what it means to the financial productivity, and whether it makes a company a more or less attractive investment in a portfolio.